on pricing and liquidity in changing market conditions. This webinar is being recorded during the height of the coronavirus pandemic for anybody that watches this and listens to this a little bit further down the road. So I just wanted to touch base with everyone today on the way that market conditions have changed since the coronavirus pandemic first came upon us. Obviously, we've seen some extreme volatility in all markets, not just in foreign exchange, but obviously equity markets and commodity markets, bond markets, you name it. We've had unprecedented volatility. Markets are now starting to calm a little bit. We're starting to get a little bit less in the way of volatility, but things have changed and they're going to remain changed for a period of time. I'm not sure how long it will take for us to get back to where we were, but things have definitely changed. So what I wanted to do here was just briefly go through, just so people understand where pricing is ultimately sourced from, where liquidity is ultimately sourced from, why it's changed, the reasons behind that, and hopefully to dispel a few myths which seem to sort of be creeping into everyday conversations when it comes to when we speak about pricing and spreads, etc. So the first thing I want to do is really explain to you liquidity and pricing, where it's coming from. Okay, and the vast majority of pricing, certainly in foreign exchange, is coming ultimately coming from 15 to 20 tier one banks. And when I say tier one banks, these are the big banks from the US, UK, France, Germany, Japan, etc. Big name banks that you've all heard of without naming any of them. There's also going to be probably a number of high frequency hedge funds that have got involved in this space as well. And they've certainly become very prevalent in the foreign exchange markets over the last 5 to 10 years. So that's where the vast majority of liquidity is sourced from. And, it's not input into the foreign exchange markets, into the global markets as we see them manually. It's an automated process, which is pretty much all controlled from algorithms. Banks spend hundreds of millions of dollars each year on developing algorithms and their own trading platforms, etc. And it's a very sophisticated setup. Saying that, a lot of the foreign exchange liquidity is based around two of the main interbank dealing platforms. Now, not that matters too much to us in the retail world, but that's kind of why they're all quoting similar prices, because they're all sourcing the price from essentially one or two sources. It gets a little bit more complicated when you start talking about maybe commodities and stuff, but for foreign exchange, it's really sourced from two different interbank platforms. So those are the main liquidity providers in the market, and obviously, they have to adhere to their own risk management procedures. They're in it to make money. They want people to deal on their prices, either side of their prices, and ultimately earn the spread from customers doing that, and that's why it's attractive to them to provide liquidity into the market. No one's making them do it; they don't have to do it, but they choose to do it, and they choose to do it for one reason, because they want the volume, and with that to capture spread. So that's really where liquidity pricing comes from. Now, spreads in general over the last month have widened. As I said, they probably started to tighten up a little bit now, but we've seen a widening in spread. And that's really just reflective of the volatility that we're seeing in the markets. The banks themselves, they have to, they have to protect themselves. They have to be mindful of the sort of risk that they're taking. And obviously, when markets are moving very quickly, they have to widen the spreads to be able to reflect that. It's part of their risk management, okay? And that gets reflected in what we see. Now, prior to coronavirus, when nobody had ever heard anything, you would see euro dollar, for example, it could be anywhere between 0.6 wide, 0.8 wide, somewhere in that region. Now we've seen, plenty of times when it's, maybe being 2 pips wide, 3 pips wide, 5 pips wide. It varies, and that's euro dollar, which is the most liquid of pairs. You start looking at some of the less liquid pairs like dollar Swiss and sterling, some of the crosses, Aussie and Kiwi crosses, and they start widening out even more. And that is just reflective of volatility price. It's really the price of the volatility, if you like, is the spread. So again, it's a perfectly normal market phenomenon. You see it all the time. Unfortunately, I'm old enough to work through some challenging markets in the past. The financial crisis of 2008, 9/11 back in 2001, and then prior to that, a couple of times through Gulf Wars, and during all those different periods, you will see a natural widening of prices. So it's not some sort of conspiracy theory. It's no one's ganging up. That's just a natural market phenomenon, and you can expect that to stay that way for now. Now, another time we're going to see, there are two other times or occasions really, which I wanted to touch on when it comes to widening of spreads. And this is very important because you as a client have to understand that, this was already happening anyway, but it's just highlighted more now because spreads are generally wider. So when they widen a lot more than they were. The first one is over a data release, okay? Obviously, non-farm payrolls in the US is probably still the biggest data release, but any significant data release, whether it's a US data release or European or UK or Australian, Canada, it doesn't really matter. You will notice that spreads will start to widen out, specifically in those currencies that are likely to be affected by that data release. You'll see the spreads start to widen out, 10, 20, maybe even 30 seconds prior to the data release. And again, that's perfectly normal. That's been going on in the markets ever since I've been in the markets, which is over 30 years. And the reason for that is as a trader at a bank and you're a liquidity provider, you don't want to be dealing on a price that is about to move 0.5% or 1% away from where it is now. Yes, I guess it's a bit of a coin toss. It could go your way, it could go against you, but that's not sound risk management. So to protect yourself, you widen your spreads so that you discourage people from dealing right before the data comes out. And that's a perfectly normal phenomenon within the market. And now it's just highlighted more because you're starting off with wider spreads. So now when spreads widen before a data release, they seem a lot wider maybe than they used to be. But ultimately, that is the liquidity providers protecting themselves, and we have to respect that. Ultimately, we are nothing without our liquidity, right? You've got no prices, no one can trade. So we have to respect that. So that's one time when spreads start to widen out. Now, the second time, which seems to cause a lot of issues in the retail industry, and is something which I think is very widely misunderstood. At the end of the day, the trading day, the meta trading day, which also coincides with the interbank market trading day, it's basically 5 p.m. New York time is the end of the trading day, which equates to 2400 or 2359.59 on MetaTrader. That is the end of the trading day, and oftentimes we see just prior to that what we refer to, I guess, in the retail world as rollover. We see spreads start to widen out, and then thereafter we see spreads remaining wide for quite a period of time. Again, this is there seem to be a few myths around why this happens. It's not a conspiracy theory. There's a very good reason behind that. It's because all the banks and hedge funds and liquidity providers are out there. As I said, most of the pricing, or pretty much all their pricing, is going to be controlled algorithmically, and they have some very complex systems that are handling that. When it gets to that end of day, that 5 o'clock New York time mark, the 2400 hours mark in MetaTrader, all of these systems are now flipping over to a new trading day and then a new settlement date, and they end up having to run their end of day processes. The vast majority of banks have to take their pricing down in order to facilitate that. That can be in some cases, it can be for a couple of seconds. In a lot of cases, it can run for 10 or 15 minutes. Okay, so the spreads tend to widen out. There are less banks pricing. They widen their spreads out because it's a time of day they just don't want people dealing. Okay, you've had all day to deal. It's just a time of day they don't want people dealing. So the reason they widen the spreads out is to discourage dealing over that sort of critical time of day, so they're not they're not putting too much strain on their systems, and they can complete their end of day processes. That's really the reason why that happens, and that's why you see, as time goes on, after the new day starts going, you start to see spreads slowly start to tighten up again. But that's the reason that happens. And again, it's a perfectly normal market phenomenon. Again, you will see it, less pronounced in something like euro dollar and dollar yen than you might do in something like sterling or dollar Swiss, or some of the much more illiquid currencies. But again, it's important that you understand that, and when you are taking positions over rollover, you need to make sure that you've got enough funds in your account to be able to hold that. You don't want to get liquidated on a wide price. Now, we do our best to try and protect you, and if people do get stopped out, we do our best to try and rectify issues. But it is a normal market phenomenon, so you do need to make sure that you have enough funds in your account in order to be able to hold that position. So that's something very important to remember. And I think there's a lot of misperceptions around why that happens at 5 o'clock, why spreads start to widen, and why it takes time for them to come back in again. And not to mention, at 5 o'clock, the US is pretty much going home, and it's also the most liquid time of day because you've only got Australia and New Zealand in. It's probably a little bit too early for the major Asian money centers to be up and running, like Tokyo, Hong Kong, Singapore. So it is an illiquid time of day. With that, I also want to touch on spreads in what I would classify as illiquid currencies, the currencies that trade very much according to their geographic location. And what do I mean by that? There's currencies like ZAR, South African Rand, Turkish Lira, Mexican Peso. We offer them, Hungarian foreign, even the Scandinavian currencies. We do offer them, but one thing you have to remember is those currencies are going to be far more liquid during their own time zone, i.e. when Turkey is open or when South Africa is open or when Mexico is open, than they are going to be in early Asia when none of those time zones are open. And the analogy I can really give to you there is, if you think, I personally live just outside of New York City. And if I want to go and order a pizza at 1 o'clock in the afternoon, lunchtime, I have untold liquidity for getting a pizza. I can pretty much order any pizza I want from anywhere I want. If I want to go and order a pizza at 1 o'clock in the morning, I can still get a pizza at 1 o'clock in the morning, but now my liquidity, if you like, my choices are extremely limited. And that's kind of the way you got to think about when you're trading any of the emerging market currencies, the less liquid currencies. If you are going to hold positions that are going to be outside of their natural time zone, liquidity is going to be at a premium and spreads are going to widen. Again, that is just a natural market function. Okay, it's not some sort of conspiracy theory. It is a natural market function. Unlike trading major currencies like euro, like yen, where they tend to be liquid, or at least to some degree liquid, around the clock. So please do keep that in mind, because that will affect the pricing, it will affect liquidity, and obviously, once again, if you have a position, you need to make sure that you have enough margin in your account to be able to hold that position should spreads widen. Gaps in pricing. Again, this is something which is I've seen people try to take advantage of it. I've seen people question it and query it, and again, not quite sure, not quite understanding, etc. Gaps in pricing. To give you an example, during the trading week, we have gaps when pricing is shut off. It is with us. It is with every other broker. Indices, for example, say US indices, there is a 1 hour gap between 5 o'clock New York time and 6 o'clock New York time when those indices do not price. It's downtime for those prices, and then they will reopen at 6 o'clock. We don't always see the market reopen exactly where it closed, which is what we refer to as a gap in price. Again, it is a perfectly natural market function. There might be some news out between 5 and 6 o'clock. Right now, each day in the United States, we have President Trump's news conference. Normally happens between 5 o'clock and 6 o'clock around coronavirus and the economy and opening the economy back up again. So, it can be all sorts of comments that are coming out that might affect the levels of the equity markets. If you have a position and if you have a stop loss on your position, which I always encourage you to do, please remember, a stop loss is a guarantee of execution, not a guarantee of price. If the market gaps open wider, or it just gaps to a different level, and you have a stop loss that gets triggered, you will be done at the first available price, the first best available price, and that's where you get filled. And again, that's just, that's the risk of running something over a gap. Now, that's something we have during the day. That applies to indices, that applies to commodities, especially gold has the same 1 hour gap as the US indices does. Something like the DAX interest in Germany has a bigger gap. Some of the oil products have a bigger gap as well. So you need to be very mindful of that when you're running a position. That is what I refer to as the intraday gap. The bigger gap and the more dangerous gap is over a weekend. Okay, now, oftentimes we see when the market reopens in Asia on the Monday morning, we see things opening up away from where they closed on Friday. There's 2 reasons for that. One, there could be news out over the weekend, right? You've always got to pay attention to things that are happening over a weekend. So if there's, like we've just had very recently, an OPEC meeting, a G7 meeting, a G20 meeting, there can be statements made, agreements made that could affect where the market's going to open up on a Sunday night, or Sunday night, Monday morning in Asia, Sunday night where I live. So you've got to be mindful of that. And again, if you have a stop loss on a position, you need to be mindful of the fact that you will get done at the first available price if it has moved against you. Okay, again, that is just a normal market function, but you do need to be wary of that. Okay, so when you're taking risk over the weekend, make sure again you've got enough money in your account to be able to fund the position and to be able to hold it should things move against you, or if spreads open up wide for whatever reason on the Sunday night. Same thing. You want to be able to have enough funding in your account to be able to hold a position. That's one reason. So that's news over the weekend. We had a prime example very recently. We had an OPEC meeting. Well, it was an OPEC meeting, but it was prior to an OPEC meeting. We had a spat between Saudi Arabia and Russia over oil production, oil supply, and the end result of that was we ended up with a 30% move down in the price of oil from the Friday close to the Monday morning open. It was a 30% move. That's a huge move. That's equivalent to, not quite, but near enough the extremes of the Swiss franc move we had when the Swiss National Bank pulled their intervention back in 2015. And we know what happened to the retail market then, and it caused a lot of issues within the retail market for liquidity and brokers going under, etc. So you can get those sort of moves over the weekend, and you're going to be exposed to them if you have positions. So just be mindful. Those things do happen. They don't happen every weekend. Obviously, they might happen once a year, but they do happen. So just be mindful of that. It certainly does happen. And the third thing is as well, which is probably something that a lot of you don't realize, is that it is pretty much the standard in the retail market that pricing at brokers opens up, or trading at brokers opens up at 5 p.m. New York time, 00 MetaTrader time on Monday. That's pretty much when everybody opens up and trading commences. The interbank market has actually been open for between 2 and 4 hours, depending on the time of year, prior to the retail market opening. Okay, so in that time, the market might have opened up where it was on Friday, but the interbank market has then traded and moved, and business has been transacted, which has actually then moved the market in one direction or another and moved it away from where the Friday close was. So we all close at the same time on Friday, right, around about 5 o'clock New York time, but we don't all open at the same time on a Monday. So interbank is open first, and retail tends to open, as I said, between 2 and 4 hours later, depending on the time of year, and that can also cause a gap in the market. So again, perfectly normal market function, but it's something you need to keep in the back of your mind. So really, that's pretty much all I wanted to go through, but there's a few things to think about there. The widening of prices and liquidity constraints that are in the market at the moment, which is really caused by the increase of volatility from the coronavirus pandemic. You now kind of understand how liquidity is sourced, where it comes from, why you get widening prices before data releases, why you get widening prices at the end of day before rollover, and why it takes a little while for those prices to tighten up after 5 o'clock New York time, after rollover. We talked about the gaps in prices during the week, in equities and in commodities predominantly, and then the weekend gaps as well. So, we've looked at a number of things there. Hopefully that just gives you a little bit of clarity. If you do have any questions about it, please do not hesitate to contact our customer service team, and they'll be only too happy to answer your questions. If they can't, then they'll direct it to either myself or another of my colleagues. And with that, I hope everybody is safe and well. And remember, right now, stay home, save lives. Cheers.